Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, shares of Zomato are on a selling spree after the 1 year lock-in period ended for promoters, employees, and other shareholders who bought the stock before the IPO. The company had a blockbuster listing, but its first year as a public company hasn't been easy. The stock is now trading about 42% below its issue price, whereas if you compare it with its 52-week high of 169 rupees, it has eroded almost 75% of its value. So, where is the stock headed? What should investors do? To discuss this and much more, I'm going to be joined by a very special guest today. We have with us Mr. Divam Sharma, who is the founder of Green Portfolio. Thank you so much, Divam, for joining us on ET Markets.
Thanks, Tanya.
So, Divam, your take on the carnage we are seeing? I mean, the stock tanked around 14% on Monday. It extended its decline today as well, another 12% drop. So, what are your thoughts?
This tells us about how quickly sentiments change in the stock markets. We have moved from a high growth driven, aggressive market sentiment to a value driven and cash flow driven markets. In Jan 22, Swiggy, which is a private company still, raised funds at a valuation of $10.7 billion. Now, if you look at Swiggy versus Zomato, these are two players which go very hand in hand. So both have almost equal market share in the food delivery business. But if you look at Zomato's current market cap, which is somewhere around $4.5 billion, it is at a steep discount to the Swiggy, which is currently unlisted. So this also tells us about the gap in terms of private markets, where private markets and the PE investors are valuing and looking at these investments differently and are valuing them at revenue multiples, while the stock markets are looking at these companies from a growth, from a profitability standpoint. So if you also look at a similar company, which is DoorDash, which got listed a year back in US, the company got listed at $175 a share. It went up to $245 a share when the markets were rising, and currently it is trading at $71 per share. So Zomato is not isolated from other listed players, other similar listed players in the space. Another thing that has triggered obviously is the the ESOPs. There could be a lot of margin calls that would have been triggered in Zomato, as a lot of ESOP holders, and there were many ESOP holders owning more than 50 crores worth of ESOPs. They had to pay taxes, and they would have taken a lot of loans to pay those taxes, and there would be margin calls, and that's why probably after the this thing is lifted, they have gone to sell the share.
Okay, and where is the stock headed? I mean, when does it become a buy? Because it is already trading below 50 level mark.
So, Zomato, first of all, the markets would look at Zomato from a different standpoint now. It is not a private company anymore. The sentiments of retail investors are different. They need profitability. So, till the time there is organic growth consistently in the company, there is a visibility of profitability in the company, and these experiments like acquiring new companies, delivering food in 10 minutes, these get stabilized, right? You would not want the company to go through a lot of mergers and acquisitions, because the market has not given them funds to do so many mergers and acquisition. Even if you look at Blinkit,
Yeah.
The transaction was done which is ensuring a 8% dilution in the equity of the shareholders.
Yeah.
Also, if you look at another fact, that before this deal, 10% of Zomato was owned by Dipinder Goyal, which he sold off to Tiger Global, and then the Zomato acquired completely Blinkit. So all these transactions are obviously they have to pan out, right? And for investors, from the kind of investors, they are not PE investors who would have a 7 to 9 years kind of a horizon. So the road to profitability would definitely be looked at from the stock to go up. Having said that, the stock has fallen a lot. The selling pressure is almost over with so many volumes happening over the last 2 days. So it should stabilize somewhere around these levels. But for the stock to go up in the long term and for the retail investors to enter, the profitability is definitely the key.
Okay, and also your thoughts on other new age internet companies. I mean, shares of Paytm, Nykaa, PV Fintech, they have all corrected significantly. I mean, do you think that it is the right time to step in, or should one avoid?
Again, we should link it to a lot of companies or new age companies of US. So it
Okay.
is not an India centric phenomenon. The
Yeah.
global valuations of global players in similar spaces have corrected. If you look at Nasdaq, also it has corrected significantly over the last few months. So a few players like Paytm, if you look at the business model, is facing challenges with UPI gaining traction, with their mutual fund business having problems, and a lot of other issues. So Paytm is definitely no at this point in time. Nykaa, yes, it looks very interesting because it is profitable. They are diversifying into offline businesses, setting up offline shops. They are also doing small acquisitions which are beneficiary for them in terms of brands getting included in their kitty. So it definitely looks interesting at these valuations. PB Fintech, I think there will be a consolidation in the sector very soon, and this this can be looked at, but we have to look at the burn stabilizing before investing into this company.
Okay. And lastly, talking about the Q1 earnings, I mean, investors surely would be keeping a close eye on any comments and data points related to profitability. So, what are your expectations from all the newly listed companies?
See, for Nykaa, I think it should be a flattish to negative kind of a earnings this time because of the consumer sentiments. I think it was down in Q1 because of high inflation and global macro and economic turbulence. So Nykaa should be flattish to negative. PB fintech should be fine, I think, because there was a growth. Uh, the business insurance uptick was there. Paytm should be fine, but I think there should. It all depends on the lending business of Paytm. So
Okay.
that is showing growth. It all depends on that. Zomato should be positive. The revenue growth should be positive, but the burn should increase because Zomato has resorted to a lot of discounting in its requirement to grow the business.
Okay, and also just one last question, Divam, since you mentioned about Blinkit deal. So, do you think that the acquisition will hurt Zomato's path to profitability going forward?
Oh, it'll definitely hurt the Zomato's part to profitability. See, this if you look at this space, there the competition is more than the duopolistic market, which is the food delivery business.
Okay.
Uh, this space of 10 minutes delivery is yet to pan out. As we have seen, Blinkit, the overall burn has was increasing quite a lot. That's why the company was not able to manage its financials. That's why this deal was structured, and the complete company was taken over by Zomato. So digesting this and getting synergy benefits out of it is going to take time. So definitely it will take longer for Zomato with the kind of cash commitment that they have done into the business, as well as the type of business that Blinkit is in.
All right. On that note, thank you so much for sharing your thoughts and for taking the time out and being with us here on ET Markets. Thank you so much.